So I think we have Donald and me and Hillary. Hillary, you're on the investor side as well, yeah? In your name and Charlie's stuff before.
Not really.
Oh,
An extremely part-time role.
okay.
But I'm happy to share whatever limited experience I have there.
So I think I will include you as you choose. So I think it's me and Donald. Are there any other investors in this room? Okay, I think it's just the two of us. So what we did last time, we happened to be in the same room the last time as well, is we'll just let you guys ask questions.
Cool. I had one that.
Oh, I'm sorry. We did introductions last time just because we're all new and you may not know us. So Hillary, do you want to go first?
Sure. Nice to meet everyone. My name is Hillary Mason. I actually founded a new company in mid-February. So I have one co-founder. There are two of us. We're building our first prototype and have our initial folks using it. So that's the stage I'm at. This is my third company. And then I'm also the data scientist in residence for Excel Partners. So I do mostly technical diligence in the process with them. So not writing the checks myself, but usually working with the partners there who do.
Cool. I'm Shripriya. My quick background is I'm at Spero Ventures. We're a $100 million fund. We primarily write late seed or early Series A, rational A checks. My background is I've been in Silicon Valley since '99, primarily in product and product marketing roles. I ran global product for eBay for a number of years. And then I went to graduate film school at NYU, and then came back to tech. And I've been institutionally investing since 2015. Yeah, Donald.
Hi, I'm Don Stalter. I'm with Global Founders Capital. We're a $1.2 billion fund. We do a lot of early stage seed investments, consumer, software, healthcare, biotech. In a previous life, I was at Airbnb, at Groupon, and then I was an M&A banker doing deals with Google and a variety of other internet companies.
Great. So we just want to open it up to you guys. It's really your questions. Anything that, as Charlie said, there's no, this is a very basic. There's nothing called basic. Everyone has to do it the first time, and this is the best way to learn.
Hi, Paul here. I had a question on just like managing runway in this particular environment. Andrew said like during the opening session, you try to have 18 months of runway. That sounds kind of like the normal amount you might want, not like particularly different than the COVID amount. And so, yeah, just thinking about our sort of original plans at the sort of launch seed stage to basically like try to invest heavily up front and try to show some growth to go out and raise. Now my intuition is to pump the brakes and just give myself like a longer fuse. And so I know there's not an exact answer and every situation is probably a little different, but what's your general intuition about sort of like investing for growth, laying low, and sort of just like waiting as long as you can to then start investing? Like how should one pace themselves, especially at the very early, like newly launched, like we just did our soft launch, kind of beta launch last week, which is on schedule, but we were planning on sort of like really like going for it. And now it's, I'm not sure what we should be doing.
I mean, when you say kind of going for it, is it you want to invest dollars into marketing, or
yeah, I guess that's the, like, investing into marketing, expanding our development resources to build faster. In other words, there's still some period we're going to be experimenting and figure out how to most efficiently spend on something, let's say like marketing. But then the plan was, once we sort of found the right places to invest, we have capital to invest. And now I'm wondering, like, even if we find those spots, should we just sort of hang tight, rely more on organic, more on earned media, more just go as long as we can without running out of cash? And is that the best strategy right now for a consumer-ish, like very small SMB type of startup? If you're interested, by the way, my company is Bounce House. It's bounce.house, hot off the press. It's like a marketing suite for super small SMBs.
I mean, I think, more runway is better. If your model is one where your unit economics are compelling, where you've got product market fit, and where if you put in $1, you get out 2 or 3. I think there's still a lot of investor interest. The people are still active for sure.
Yeah. What do you think are the conditions where that would change? Like, we're only a few weeks into this thing. What if anything makes it so that all of a sudden early stage VCs get squeamish, even if they're not now?
I mean, I think there are a certain percentage of early stage VCs who are not investing at all right now. It could be that more, sort of put themselves on pause. It could be that, the market or the news changes dramatically, and then kind of more decide to invest. So I think, I think that there are kind of 2 different layers to it. I think, what's going on with the market right now is impacting how investors, the world of finance sort of thinks about investing kind of period. And then, then I think it comes down to sort of second layer, what is the business? I think, someone who's a smart investor, an angel investor, anyone who, has a little bit of money, will want to put money into something that's compelling and exciting. So I know it's, sort of a bold stroke sort of answer, but that's how I'd think about it.
Yeah. No, that's helpful.
I think what could change is we now have, I think it's close to 20 million unemployed. Like, if people look at it and say, like, hey, this is a market, this is a product that serves people who are severely affected, or SMBs need money to pay, or we're in a longer term recession. Those are things that will change how investors look at sectors, right? Because what they want to see is like, hey, will there be customers for this? And if they say for the next 18 months there are going to be no customers for this, then it becomes harder. But if you can show that, as you experiment with growth, what I'd say is do many small experiments. And if you see something, click, and you're seeing the return, as Don said, then put a little bit more money there, right? But never spend all of it on anything, but a little bit more and a little bit more. And if you can actually like say, oh, this is interesting, we're getting more back, as you mentioned, then we're putting in, then it's actually a business that makes sense, right? But you still have to watch runway, because if you're convinced this is your whole life, you have to convince other people that this is going to be sensible during these 18 to 24 months, and that you'll come out with where others are going to want to follow and invest on, like early 2021 or early 2022 or late 2021. So
yeah, exactly. I worry that even if we sort of hit the right marks, that might not align with when the VC market is feeling optimistic, and so you kind of want the extra buffer.
Yeah, you do want an extra buffer, but remember that a lot of funds have already been raised, right? And
have to be deployed in any case.
I mean, they don't have to be deployed, but if VCs see a good opportunity, they're going to want to deploy, because they will say, hey, I can get a better price than I could 2 years ago, get better ownership. If I believe in this business and I believe it's going to last, yeah.
Right. One thing I'd say too is, really smart co-investor told me, entrepreneurs who build close relationships with VCs, with investors, and kind of prioritize that, have those relationships, over the course of the creation of their businesses, will be able to pick up the phone when they want to do a super seed round or sort of whatever else, and increase the probability of getting that done. It's always better to have warm relationships than go out sort of cold and kind of run a quote unquote process.
Yep, totally makes sense.
Hi, I'm Emily. Can I go?
Yeah, go ahead, Emily. Sorry.
Cool. Thanks. I love the sneaker collection in your background, by the way. My company is Chorus. We're a matchmaking app where friends swipe for friends. So you can't actually swipe for yourself. It's all about friends helping friends and bringing community and accountability back to modern dating. We are now experimenting a lot with virtual dating. I don't think that's going away. I think that will be a lasting trend. And we were gearing up to raise our seed round later this year. We have like 6 months runway at most, I think. And we were really seeing a trend around events for growth. And we were like about to just go hard on events. And now we're shifting to virtual events, but it takes some time to kind of figure out how to leverage growth through virtual events. So my question is a couple of things. Like, this is very standard, but I just like to hear from different VCs, like, what are you looking for in a seed raise? Because I know there's no like magic number of users per se, but like, what are key signals for you? And then we haven't spent money on paid advertising because I've been cautioned away from that at this stage. It's all been organic and our referral rates are very high. But like, do you agree with that? And especially now, given that in-person events are so limited, should I be experimenting with paid marketing at this stage, or like just kind of thoughts on that? So yeah, curious.
Hillary, do you have thoughts?
Sure. Sorry, my unmute button wasn't cooperating. I mean, I have so much empathy for the challenge of having a business that's all about people meeting in person, that you suddenly have to, make work in this world. So that's amazing that you're finding a way through it. All I would say is, on that question of paid advertising, treat it as an extremely rigorous experiment. And so if it turns out like you find a paid channel that actually yields like valuable long-term engagement, that's wonderful. And I've heard from a bunch of folks that things are very weird right now with their paid channels. So some of them are undersaturated, some of them are oversaturated. So it's a really good time to see if you can find some angle that maybe works really well for your particular audience that is, cheaper than it otherwise would be. But I'm not the one who writes the checks, so I'm not going to say like these are the metrics I would look for, because that's not really where I spend my attention.
Cool, thanks. Does anyone?
So seed for us is just early for a consumer business. We primarily invest after that. So I would think of, just like the way I would look at it for now is look at what are your new user numbers coming in and what is retention and repeat usage, because you're now moving to virtual, and it's great that you've adapted quickly. But I would use retention as a proxy to say, like, look how many times people are coming back to be helpful. Look at success rates. Because if you can show that there are, 1,000 or 5,000 people who are just obsessed with this product, and you can say this is how it's going to, and tell the story this is how it's going to grow, then I could think it could be really interesting. Because the actual numbers when your model has changed are going to be hard, right? Like, because you've dramatically changed how you're like thinking about the business. So think of proxies that can give people comfort on deep passion for the product instead. And also think about what could you change about your raise to make it easier and lower the bar for VCs to say yes, right? If you could say like, hey, I can raise, like because we're in this world and I had to make all these changes, I can get myself to early 2022 with this much instead of what I was initially thinking of.
Yeah.
And make it easier for them to say yes versus be like, oh, that's, like the numbers aren't there or whatever. Yeah, so cool.
Thank you. Yeah.
Yeah, I'll jump in. My name is Brandon Martinez, co-founder and CEO of Sneakerhood. We're a mobile platform for sneakerheads, hence all the sneakers behind me. I guess kind of like what I'm really interested in, I think we're all really thinking about it is what is the new normal going to be? And I'm really interested to hear that from your perspective, like, if you want to look at specifically from, the deal side, like what changes, 6 to 12 months from now, once we all quote unquote, like go back to normal. I know we heard a little bit about like, meetings and working a little bit more from home, meeting a little bit more virtually, but, what are some of the things that we should be thinking about, either in terms of metrics that you might be looking for, or even just like consumer behaviors that we should really be thinking about as well? Oh, Don, if you're talking, I think you're on mute.
Can you hear me?
Yeah, there you go.
So from a VC or an investor standpoint, I mean, I think, folks are probably going to be investing at lower valuations. I think, technology enabled service businesses, i.e. businesses that, maybe previously would have commanded software multiples will be considered, considered sort of less valuable in some cases than they may have been kind of in the era of SoftBank, kind of depending on the scenario. I think consumer behavior is, there's this sort of remote stuff that everyone's doing right now, has accelerated very dramatically. It was a thing kind of prior to COVID, but it's been compressed and accelerated. And so I think, folks are going to be remote, and they're going to be a lot more comfortable being remote at a much bigger, kind of broader scale.
Cool, thanks.
So I think there was many questions embedded in your question, right? Like in terms of like when will we go back to normal? I don't know. I don't know that it's 6 months. We may have to wait till there's a vaccine to really go back to how it used to be, for safety reasons. So there may be a spike again in cases over the winter. Nobody knows what the next 6 months are going to be. So we're not presuming that taking things, in July or in November even. What I will say is, from an investor perspective, we've gotten very comfortable just making decisions, just doing everything virtually and doing everything from like we are right now. And then in terms of consumer behavior, I think you guys will be closer to it than we will be, because you will see the immediate impact on your business, right? Like for sneakerheads, is it more about just having it and showing it, which can be done virtually, or for people to see it in real life, which will then have an effect on like what people are purchasing? You'll see that probably sooner than we will. And I think it's important when you're trying to fundraise to kind of share like what the impact has been in a very honest way, right? Because what has the impact been? How do you see it changing? Tell your investors who you're talking to, like where you see consumer behavior going in the most honest way you can. Because the reality is, when someone invests in you, they're going to be with you for like 7 years, right? Yep. And so painting this picture of that's not reality in the next 3 months or 6 months is going to damage your relationship. So I would actually spend a lot of time thinking, talking to your customers and saying like, how are you thinking about this world? Are you going and know your customer really well and share that back with investors to give them comfort in terms of like, hey, this is how our user base is seeing this. Are they going to keep buying? We've set up like a virtual share your sneakers room, or, you know, like a virtual meetup where people can like take pictures of their shoes, or, you know, like whatever it is that you're going to do to adapt and still build community around that. I think will be really interesting for your investors to hear, and how your business can thrive in this, in a world where we're only partially open compared to what we were before.
Yeah.
And in a world where we shut and open, which may happen, right? So think about medium case scenarios and worst case scenarios and how you'd plan for that.
Yeah, yeah, it's really interesting for us. I mean, where, you know, right now in our world, everything is in the investment side has been all focused on consumer, or the consumption, like purchase, stock X and go to raise these big amounts of money. And we're about, no, it's much more about your collection and being at home and sharing it. And that's where the community is actually focusing on. And I
Yeah.
think that we're already obviously seeing a dramatic drop in retail. And I think that we're seeing that it will go back towards that. So yeah, I think sharing our perspective on that and having those user profiles or sort of you know, talk points to back it up, I think is really helpful. So thank you.
Yeah, one of the things we had thought about before COVID hit was something called product-led communities. So we said, you know, when people have a goal, right? Like if they want to start meditating, or they want to learn something, or they want to spend their time on achieving something difficult that takes a while, when community is plugged in early, it can 10x your product experience,
Yep.
right? And so we called it product-led communities.
Sure.
And I think going through COVID, which hit after we had spent a lot of time thinking about it, we actually think that's even more important, because when community is truly engaged, it's not going to be here today, gone tomorrow, because it's transactional. It's you're developing these relationships. You're going through something with people who are helping you go through it with you. And, you know, versus your neighbor, which I appreciate my neighbors, right? But I might not have my sneakerhead obsession with my neighbor. I may have it with you who's in New York, right? And so like it's the desire to come back and develop relationships that can actually improve the product experience on your site.
Yeah.
That can get you through some of these things.
That's great. Yeah.
And we think about it for B2B as well as for B2C, right? Like when community gets engaged, there's something powerful that accelerates usage.
Absolutely.
Any other questions? Katie or Jendi or Kevin?
I had another one if no one else
Sure.
does. Thinking about sort of product features sort of well suited for the current moment, things that are really great for users, in my case, like sort of super small SMBs, think like one person businesses. So our target market is basically one person service businesses, fitness instructors, accountants, yoga teachers, SAT tutors, like people whose typical business is going to someone's home and getting paid by the hour to do it. So all of a sudden, obviously that is like, no one's doing that right now, but those businesses are quickly pivoting to online situations. And the question is, how short-lived is that? And I know you don't know the answer any better than, you know, Dr. Fauci does, but it's very tempting to suddenly get all crazy and be like, I know we should build a whole live streaming thing. And then it's like, you know, but if that takes 6 to 8 weeks of dev, and then still it's kind of like a shitty MVP version of it, and now everyone's back at work, like maybe we just should have stuck to our original plan. And so it's you know, to generalize the question, like how should an early stage startup that is quite nimble in its ability to create new things, you know, you see New Balance, Brandon talking about sneakers, like they're making masks already, like that's already happening in their factory. And so there's some equivalent in the software world, especially when a business isn't well established yet and is trying to find its product market fit. It's like, oh, well, there's a lot of market need right now that we could try to sort of map ourselves to, but is that sort of a fool's errand because it's going to end up being sort of a fleeting moment in time?
I think like if you can do something that will be applicable post-COVID when things come back,
right,
then you can have the best of both worlds.
Right, exactly.
If you can identify something where there's a Venn diagram, where there's a crossover, and you're investing resources in that, then I think that could be a smart approach. Right,
things that were potentially on our roadmap anyway, but that sort of get
maybe you leap forward a little bit. Yep.
Right. Yeah, the Venn diagram approach is a good.
I'd also say that startups should use as many resources that already exist, right? So a live streaming platform, when you have Zoom and all gym instructors, all like physical trainers, and even soccer coaches have moved to Zoom, doesn't make sense. I would not recreate that. I would just use that, and if there's something that you need to validate that the class happened or something like that, have a little link, but not recreate what someone else is already doing really well and at massive scale that a startup cannot. Right? Just think about how much can you leverage other people that are already doing those things well.
Right. Like some of our early just user research is saying, I'm doing these Zooms, but I'm like collecting payments in all these random ways through Venmo, through whatever. Like it'd be great if I could just have payments through my website. That does seem something that will outlast, shelter in place. For instance, even though there are also so many payment gateways. So, something we're trying to do, to your point, is figure out just how to create like a good workflow, but maybe from existing tools to help some of these folks. But yeah, there's like a get rich quick kind of mentality. Like, ooh, I could start selling COVID kits, like, and I'm trying not to fall into that.
So the one thing I would say is, if you feel like your business has been impacted kind of at its core, like, your product market fit's been sort of derailed off the back of some of this. We've seen some of our smartest entrepreneurs, contrary to our advice in some cases, pursue consulting alongside kind of their existing product building sort of workflow. And that demonstrates, I think, resilience to us in a lot of ways in this environment, given the uncertainty, and makes us also understand, I think, that some of our founders are sort of capable of doing kind of many things at once. They're MacGyvers, so that's one thing that's been sort of interesting.
Yeah, that's interesting, right? Like all the normal rules are off about service layers and whatever, doing things that don't scale.
Just a question. And 4 minutes. So Katie, sorry to cut you off. Paul, just want to make sure we could get to her. Katie, jump in.
Yeah, no worries. So first of all, hello everyone. My name is Katie Nowak. I'm the co-founder and COO of a company called The Difference. We're a telehealth platform solving the equation to be able to provide consumers with acute emotional relief. And that means that we connect you to a therapist in 30 minutes or less, because we believe the right talk at the right time makes all the difference. I think that this conversation has been so helpful in terms of covering everything, all my initial questions of, what is the VC climate? How should we think about paid marketing? I think that it's great to hear some discussion around product-led communities. I think that's something that we definitely have embedded in our go-to-market strategy. Community is super important to us on both sides of the equation, for our employees and for our users. And the consumer behavior point definitely stood out to me a bit. I think, obviously we want to capture as much data as we can from our enterprise users, our consumer users, our therapists. Are there any interesting, innovative ways that you have seen other portfolio companies that you've worked with demonstrate their knowledge of consumer behavior in terms of thought leadership, podcasts, anything that's like a bit more unique outside of internal data analytics?
Not yet, just because it's been 5 weeks, but we have seen 2 or 3 companies make significant adaptations to this environment and really see success with it, right? So, and and of course they're tracking that data. So, one was a completely in real life experience company, which was, like getting people to see like uh, shows that were not, at the top level, but like allowing Gen Z and millennials to find ways to connect and see very unique experiences. Was completely offline, right? Where people voted for the shows, those shows would happen, they would go. Experiences, they pivoted entirely online, because they realized the artists themselves were taking such a big hit, right? Because they weren't able to perform. So they've pivoted completely online and are seeing, I mean, knock on wood, like real success with it. And so they are tracking all their metrics on something like that. So what, I mean, I don't think they've shared it out yet because it's been 4 weeks, right? But I've seen them like experiment a lot, like use this time to really experiment with new things they would never have considered in the old world and see a lot of success with it. And maybe it'll always have two ways, right? Like where it's the offline experience that they originally thought about, and then they'll expand their audience with this online platform, which they would not have built if COVID hadn't happened.
That's helpful. Thank you.
So, thank you all. We'll be back. See you back in the main room.
Yeah, thanks so much. That was great.
Thing to say, given that everyone's still sitting in the same spot they were sitting in before. But I'm pretending we're at we're at our venue. Actually, I don't even know if most people know, but when we had planned this, we had actually secured and booked. We got our money back, but the vintage TWA terminal at JFK as our venue for this. We usually like to do it outside of Manhattan, and then it became very apparent very quickly that an airport was the last place on the face of the earth that anyone should be holding a gathering of any size people. So we may do that in the future. It's a very cool location. We're disappointed that we couldn't do it, but yeah, that was like, couldn't have picked a more or less appropriate spot given that time. But we got our money back, so that was good. All right, so before we start our next panel, we're going to do 2 things. One is we're going to ask that every person who is not on the panel to turn their video off. This way we could put the folks on the panel at the top of the screen. Our panelists are going to be Shri, Michael, Ashley, and Don. And I would say that now that you have this moment of no video, feel free to stretch your legs. Because I recognize that there may be many of you who might not be wearing pants. So we'd prefer you stretch your legs when your video is off. You never know. So far I haven't, the top 2 stories or things that I've seen in terms of Zoom fails are somebody from a portfolio company of mine is quarantining with their significant other, and their video unfortunately looks directly at their bathroom door, and they were sort of on mute and trying to talk to each other through the door, and he like opened the door to, yeah. So anyway, and then I've had a couple of shirtless family members just kind of walk through the background of people who are quarantining with family members at home. Usually like, older dads who, in morning calls and stuff like that, which, we've all been there. So it's totally fine. Let me just check our head count. I think everybody's back, or most of everybody is back. And so, yeah, why don't we, before we start off, we'll just have our panelists introduce each other. Shri, you want to start us off?
Sure. Hi, I'm Shripriya. I am at a fund called Spero Ventures, which is a $100 million single LP fund where we invest in the things that make life worth living, well-being of people on the planet, work and purpose, and human connection. My background, and I apologize to those who've heard it a couple of times already today. I've been in Silicon Valley since '99, primarily in product and product marketing roles. I ran global product at eBay for a number of years, and then moved to New York to go to film school at NYU, and then moved back to tech. And I have been institutionally investing since 2015. And I've known Charlie since
2006.
2006.
Yeah.
So.
Cool. Michael?
Sure. Hi, everyone. Michael Carney. I'm a partner at Upfront Ventures in Los Angeles. We are historically an early stage fund. So we have a $400 million early stage fund, mostly seed and series A, tend to lead rounds, be pretty active and hands-on. Recently raised our first kind of external facing growth funds who are also investing out of that as well now. Kind of series B through D type deals. We're not, leading pre-IPO rounds or anything, but kind of beyond the series A where we normally enter as the core fund. Spend most of my time in fintech, real estate, insurance, kind of SaaS generally. And then, we as a firm are kind of cover all the bases except for life sciences.
Cool. And Don?
Yeah, I'm Don Stalter, based in San Francisco, covering the US with Global Founders Capital. We have 1.2 billion under management. We usually come in at the very early stages and then try to double down kind of in subsequent rounds. We don't have target ownership. We're also, able to do growth investments. We invest across consumer, software, healthcare, biotech, clean energy, and we have sort of expertise in-house to help us, partner up with businesses in those categories.
Cool. And Ashley?
Yeah, so I'm at Lightspeed Venture Partners. I focus mostly on consumer and early stage consumer, so seed and series A. I'm especially excited about vertical social communities, marketplaces, and also the aging economy. But broadly, the fund is $4 billion in the current funds that we're investing out of, and pretty much any stage and nearly any industry sector. So very broad focus overall. And previous to flipping over to the investing side, I was on the product team at Thumbtack, and then also did some projects with BetterUp, which is a mental health company, and Fundbox, which is a fintech company. And then before that, I started my career at Bain & Company.
Cool. I'm so glad you're focused on aging, because we have aged a lot in the last couple of weeks. So.
Oh my gosh, totally.
Cool. So I'm going to go in starting out pessimistic and work our way towards optimism for the arc of this panel. And I'll just kind of kick it off and say, like, who do we think the most bearish person on this panel is? Does anyone want to, raise their hand and say, you have this near, how bad is the sort of near-term projection until we start to see something like normal? I guess by the nature of being a VC, we have to be a little optimistic.
I wouldn't say I'm overly bearish, but I think the recovery is going to be slow. So even if we get back to work, or if we kind of get a handle on the virus, I think there'll be a persistent anxiety amongst consumers and businesses, just in terms of how they spend money, where they spend time. I actually read a great analogy, or I thought it was a great analogy the other day, which was our economy or any individual company is like a really complex Lego set, and it took all this time and these instructions to build it together, and somebody just knocked it over and all the pieces are on the floor. And so the idea that you just kind of build it back up, you hire tens of millions of employees and you kind of go back to work tomorrow and it looks exactly the same, is probably unrealistic. And so again, even if we open up June 1st, July 1st, whatever it is, I am of the belief, and we've been counseling our companies, our existing companies certainly, to plan for a slow recovery. You know, things may look different for a period of time, even if quote unquote we go back to life as normal. So in that sense, I would say I'm pessimistic on the speed of the rebound, even in a kind of a good case scenario around the healthcare crisis.
Given that, do you think that the time horizon in which people should be raising for now, if they're pitching, should be extended, that we're going from a 12 to 18 months to, should people be thinking about pitching 24-month plan, 36-month plans? Shri?
I think 24. I mean, we tried to get all our companies, even those that were planning to raise over the summer, into early next year. And I don't know that it will be good even early next year. I think I'm with Michael in the sense that I think after summer of next year, towards the end of next year or early 2022, we'll start really feeling much better. But we're trying to get them to tell stories that if they're raising now, will last them into 2022 and be at a revenue rate where they can raise their next round, right? And that's the challenge, because even if you can make the money last, can you hit the growth goals that will get you a Series B valuation? Will you be at whatever the revenue numbers are that will get you that raise? So that's the challenge.
So Don, you guys participate across a number of different stages. Do you think the bar has shifted, or in companies, like how will you guys evaluate maybe even some of the later stage stuff? How will you evaluate this year, right? To Shri's point, a company who makes the runway last longer, may be doing it with less people, may not hit what was otherwise considered to be the Series B level before this, but still might have some growth. I mean, do you think the bar has shifted, and that you'll maybe be doing different types of rounds at different stages?
Yeah, I mean, I think we find a lot of value in our capital at the very early stages. I think valuations on growth rounds, particularly over the past few years, have been impacted by likes of SoftBank. The market just being just such a bull over the past 12 years. I think you always have a chance to start anew, or really be part of sort of the nuts and bolts creation of something at the very early stages. I think kind of agility of entrepreneurs across every stage is something that's totally key. I think the ability, as we've talked about kind of many times now, to be remote, to whether you're wearing your sweatpants or whatever you're doing, to be able to execute on some ideas and to actually generate some sort of revenue runway, etc. I mean, if your thesis is in a category that's been impacted, if you're able to generate service or consulting revenue sort of alongside it and be MacGyver, we tend to be very impressed. I think at the heart of it, we're entrepreneurs. So if we can kind of work side by side with people, get conviction and enjoy working together, that's what really gets our blood moving, kind of no matter the circumstances, but particularly kind of during these times.
That's an interesting point. You bring up like consulting and other types of revenue that maybe VCs weren't excited about previously.
Mm-hmm.
Ashley, do you think that you'll see more stories that are not crystal clear up and to the right, and the VCs may be a little bit more forgiving, and the pitches will just be like, hey, here's how I got here, and it was eight different lines of revenue, and it was kind of all over the place, but like, hey, we survived. I mean, do you see yourself being more accepting of plans like that, or experiences?
Yeah, for sure. I mean, I think it all has to be taken into context, and with the current downturn, I think we're going to be looking a lot at how people are reacting, and are they reacting fast, and are they reacting in a way that makes sense for their business. And I think that's a really good bellwether of how strategic they are and how fast they'll be able to rebound. So I think whereas in the past we may have looked a lot more at metrics and wanted to see things like 3x year-over-year growth or certain revenue hurdles, Rather than honing in on that, I think we'll really hone in more on the quality of the founder, the quality of the founding team, and what actions have they taken to make the most of the situation and to put their business in a strategic position to take advantage of the new opportunities that are coming out of this time.
Founder quality is actually a really interesting point. In working with especially your current portfolio, what are some of the qualities that the founders, when you walk out of some of these meetings, I know I personally can think of a couple of companies that are the worst hit, but I have the most confidence in the founder from how they acted. What are some of the things that have emerged from your portfolio in terms of founder qualities that give you confidence and maybe even inform the kinds of founders you're looking for during this period?
Yeah, absolutely. I think it's people who recognize the reality of the situation and are taking a realistic view. So there's been some cases where people model out different scenarios and sort of what they think is the worst scenario, sort of I would more consider a middle of the road scenario. So folks who are really realistic and understand that, like, hey, bad times are coming, and here's how we can hunker down and get prepared. So I think that realism is important. I also think, people who are willing to pivot, people who are willing to break the rules and do things in a different way than they've done in the past just shows a lot more sort of innovation and innovative thinking. I do think there has to be a lot of precision with how people are operating, given that there's just less cash to throw around. So folks who are taking a measured approach to those more opportunistic decisions, and doing it in a way where they realize there's just fewer shots on goal, and they need to get it right.
I just wanted to kind of add something in here. I think the other attribute of this situation is that there's a ton of uncertainty, and off the back of uncertainty, resilience is a really important thing. And I think people's sort of emotional health, et cetera, has definitely been impacted. And sort of being an entrepreneur is not necessarily as easy. Raising money is not as easy. And I think just having empathy for kind of the situation, and just that we all sort of help build resilience around the table and within sort of our communities is really important.
Yeah, I would reiterate the need for kind of data numeracy and kind of pragmatism, but kind of on a totally different dimension. One of the things that I've been most impressed with amongst a handful of our founders, I think, are kind of performing exceptionally in this environment, is the ability to kind of make tough and kind of company defining decisions that are painful, but then really put their hands around their team and kind of bring everyone back to the table and re-energize that team around this kind of new redefined mission. And so obviously that takes a particular leadership quality, but the companies that are, I think, going to do the best in this uncertain time are the ones that are going to get the best out of their people that stay and that kind of survive this. And so to the extent that you can be thoughtful about how to deliver bad news, but again, kind of get the train back on the tracks and get everyone re-energized and recommitted and kind of moving forward together. I think that's been challenging, obviously, but it's super important and impressive when people have done a great job at it.
Shri, you're focused on a lot of the sort of wellness and life improvement stuff from an investor perspective. I'd be curious as to what you've seen from some of the founders in terms of, dealing with, morale on the team and just some of the wellness stuff within companies that you've seen has been beneficial.
Yeah, I mean, I've seen people go both ways. Everyone's trying, right? But some people just do it better. What I've seen, just to kind of tie into your last question, is the founders I've been most impressed with are the ones who have been super proactive. They didn't wait for us to tell them, like, hey, you should. By the time I could even get to them, which was like a day, right? Like, they've already been like, hey, I want you to introduce me to so-and-so. I've already spoken to these 5 people who've gone through 2008. Here's my plan. Here's what I'm cutting. Here's where it'll get us. We've already planned like cuts across the board for everybody. It's hard, right? Like, we're laying off 2 people and this is where it'll get us. The proactiveness of the founders, who I think will hopefully get to the other side, has just blown me away. And it's those founders who've also thought about, how do I get the team together, right? So some founders are starting the morning, every morning they do a morning meditation with the team. And these teams are small because they're relatively early, right? Like they're like somewhere between 8 and 20 people. And so they're doing morning meditations. They may do lunch together. They're giving people time in the day to like deal with their personal life. And, they do like Friday happy hour. They're trying to recreate team events and camaraderie and support without making it a required thing, because everyone's life situation is different. There are people who have kids, there are people who don't have kids, there are people who are taking care of aging parents. And so I think I've seen a lot of founders think about it, and I have seen a few who don't think about it, right? And we've encouraged them to think about it, but I think it's really hard leading through something like this. It's harder even than 2008 because you can't do it in person. And so the best ones are proactive, and they're very thoughtful about, how do I motivate while being extremely realistic about where we are as a company.